Okay, everybody, it's me, Gregory Mannarino, and you. Listen, we have to talk here, people, on this lovely, and it's already starting to be lovely, Tuesday, January 18th, 2022. Where to start? How about with the markets right now, with stock futures, which are lower pretty much across the board. Nothing overly dramatic, but lower nonetheless, especially tech futures here. Why is that happening? Well, the 10-year yield right now is 1.81 the last time I looked at it. And as you all know, I've covered this before, the tech sector is rate sensitive. So, all right, I don't think there's anything major going on at all with the setup of the market. Again, look, that's what markets do. Markets waver around a little bit. I told you to expect a lot of volatility this year, and that's what we're getting. We're getting volatility now. What's weighing on the markets right now, in my view, is very, very good from a long-term perspective here. The financials and the banks are under pressure, especially Goldman Sachs this morning. Look, I love the banks. I've been telling you this for the longest time. JP Morgan, Goldman Sachs, Bank of America, especially here, moving forward. In my opinion, they are very well positioned moving forward. Period. The end. So to me, the banks are on sale. The banks are freaking on sale. As a matter of fact, most of the financial sector is on sale. The tech sector is absolutely on sale. So just ride it out. That's the way it is in this freaking business. Freak show, and that's just life in the big city here. All right, so let's look at a few other things. On top of stock futures being lower this morning, especially tech, like I just said, on the rising yield environment, the yield curve is looking okay. Yield curve looks good to me. Dollar right now is showing some strength. What does that tell us right there? We need to keep our eye on the MMRI, link in the description of this video. I would expect to see the MMRI jump higher this morning. And what does that mean? Risk is higher in the market. So look, if you understand, what are we doing, number one, as participants in the market, as traders and investors? We're speculating, right? With risk comes reward if you know what you're doing. Understand? So if we have an environment of rising risk, nothing out of control here. There are no red flags, in my view, anywhere. Okay? If we see that, and we see stock futures under pressure, especially the banks, which I happen to really love, what does that mean? What does it add up to? It's a very simple equation, and to me, it means opportunity, period, the end. I think the market's going on sale, and I will continue to buy the dips personally moving forward. And as a matter of fact, right at the open today, I will be buying more banks. I'm just telling you that right now. I will continue to buy the dips, and I think all of you understand that. Let's move forward. Crude oil is ripping higher right now, ripping higher. WTI crude is over $85 a barrel. Gold is relatively flat this morning. Silver up over 2%. Okay, that's the setup for the market this morning. We got rising risk. We got a 10-year yield higher, a normalizing yield curve. It's not a bad setup, and I think stocks are on sale in my view, gauging on what we know. And we know the easy money is not going to stop. I don't care what's coming out of the mouths of the propaganda ministry about the Fed raising rates, meaningfully raising rates moving forward. It's not going to happen. The Fed is going to continue to suppress rates from here until kingdom come, whenever that is. So just get used to it. And we get through the times in the market like this, where there's volatility, which you knew was going to happen. And we look for opportunity. That's it, people. I don't know another way to put this. And I will continue personally to buy the dips in everything, not just in the stock market. Crude oil, which is going to go much, much higher. Obviously, precious metals. Cryptocurrencies right now are also under a little bit of pressure. And I think that's an opportunity as well. It's not going to change. It's not going to stop. I will not deviate from the strategy I have used, me and my Lions have used for freaking years. I'm not going to deviate from that until something major changes. Volatility in the markets, what does it mean? It means opportunity. That's all it means. It doesn't mean we're crashing or because again, where is the crash going to start? It's going to start in the debt market, the major crash, the big one, okay? Markets go up, markets go down. We all know that, but it all is based upon action in the debt market. You all know that if you've been following this blog since like for freaking ever. That's all I really care about. When I see stock futures lower or higher pre-market, I want to know what the 10-year yield is doing. That's number one. Then I want to look over at crude oil. Then I want to look over at the dollar or the relative strength of the dollar or the Dixie. All right, now that we have the MMRI, we need to track that too. It's pretty simple to me. When I see this kind of a setup, okay, I say to myself, what's really going on? Is there instability in the debt market other than it being the biggest, most incredible bubble the world has ever seen, which has subsequently inflated a stock market bubble? No. Right now, the debt market remains stable, and the Fed is going to keep it that way. They're not ready to pull the plug. It will be a moment of their choice when they decide to allow the debt market to implode on itself, and that's going to be an epic moment. So, look, I don't think they're ready by a long shot here. And the bad economic news, it just doesn't stop. It's not going to stop. I still believe sincerely that we are going to get a Fed rate hike soon, but it's going to be nothing. And I still stick to my guns on this. The market's going to rally. The market's going to rally off of a rate hike. The market wants to get it over with. That's also another reason why we're seeing all this volatility. The market wants the Fed to do something. It's already priced in. Look at the 10-year yield. Look at the yield curve. Period. The end. The market's going to respond positively to it. That's my take on it, and we'll see if I'm right when this does happen. And it is going to happen. I know a lot of you don't believe it. A lot of you continue to write to me. Let me touch on that just real quick. I've been calling the Fed what they would do or would not do for a very, very long time. And I've been explaining pretty much during every single FOMC meeting that they would not raise rates. They're not going to do it this time. They're not going to do it this time. But this time they will. For a myriad of reasons here. Again, it's about the illusion of credibility, the complete falsehood that they are now prepared to do something about inflation, that they've surpassed their 2% target by hundreds and hundreds of percent. We are now at 7%. You got to be kidding me. So the rate hike is coming. I know a lot of you don't believe it, but it is. It's coming this time. And again, my record with calling the Fed is pretty damn good. In the last decade, I've only been wrong twice, 2 times. I think that's pretty good. And again, it's getting priced in, and the market's going to like it. The market is going to spray its shorts, in my view, over a rate hike. It just wants to get it over with, in my opinion. Anyway, so let's just recap real quick. In Greg Mannarino's opinion, the market is on sale. In Greg Mannarino's opinion, the banks are on sale big time. Big time here, okay? Goldman Sachs, they missed their earnings. Okay, you think this is going to last? With these, first of all, these Wall Street super banks have a main line straight to the Federal Reserve. They run the Fed. They're not going to fail like last time. And as a matter of fact, what happened? They had a sacrificial lamb, Lehman Brothers here. Bear Stearns got absorbed by JP Morgan. They had to do something to show the public, okay, this is what we're going to do, but we're going to bail out the entire financial system. We're going to bail out the banks. We're going to bail out the markets. So they needed a sacrificial lamb, and that was Lehman. I think that's pretty straightforward. I believe you already understand that. So look, with regard to the market, you got to realize where the sales are. And to me, it's in tech. The tech sector is way, way overdone, in my opinion. And I think the banks are on sale right now in a big, big way. So you know how I'm going to play it, and it should be very obvious to you. All right. With that said, we will keep ourselves on the right side of this, people. There's no doubt about it. You know that. And let's just enjoy the show. It's a shit show, but it's kind of fun in a way. Love all of you. Please share the video, and I will see you later.